With the failure of Donald Trump's government to push through the healthcare bill, the markets were expected to have dropped, but in fact that's not been the case. Here we are now on almost a week on from what appeared to be at the time some really negative news. Let's talk about the context of this and of course also the most recent developments in Europe with the Brexit now having been signed through and that 2-year period now having started. Karim Chedid joined us now from Blackrock. It's interesting actually looking at the news flow because as a journalist you always try and find a headline. And the headline seemed to be going out to the healthcare bill that if it failed, there would be a big reduction in US equities and the dollar, but it hasn't happened. What's going on? Give us some context.
So, Jeremy, when I look at how the market has performed ahead of the healthcare bill, actually a lot of what we call the Trump quote-unquote trades have been already giving back some of those post-election gains. So looking at the dollar basket, for example, going into the event, the dollar had already lost some of its gains, and right after the healthcare bill, it did sell off back to nearly election levels back in November. That means that even as the healthcare bill failed, the market was already anticipating that President Trump is not proving as effective as he was during his promises in terms of pushing things through Congress. And so I'm not that surprised that looking at it now, nearly a week after that bill failing, US equities are managed to actually recover really quickly and be up on the week, and the dollar managed to stabilize.
I think it's interesting actually looking at US equity markets. I think if we look at the US 500 or the S&P 500, you can see that little right-hand uptick here. But as you said, the small reduction we had going into the back end of last week, nothing like the drop we had in the dollar. This is the blue vertical line here is when Donald Trump came to power. And the Trump trade has been so beneficial for US equities.
Yes.
Where do you see that going from this point then?
It has been very beneficial. And a lot of it has to do with those promises around fiscal spend, around pro-growth policies that are ultimately positive for equities. But we are getting to a point where investors are getting the reality check that perhaps all of these policy implementations are not going to be very straightforward. I think going from here, we look at other equity markets. We see good earning growth in places like Europe and Japan and emerging markets even. And we think there are probably better return opportunities in those markets over US equities where we have that promise implementation dynamic. Within the US, obviously it's still an important part of benchmarks, but there is a need to be more selective at a sector level and at a factor level as opposed to just owning the broad market. So I would summarize it with preference for non-US equities where there's strong earning potential, especially Europe and Japan, and a selective approach looking at specific sectors within the US.
The Europe trade is an interesting one. As I said, Wednesday 29th, we had the signing of the Brexit papers. Now, that doesn't change anything immediately. We know that relationships still exist for 2 years throughout the negotiation period. But the acrimony has already started. It looks like there's going to be a bit of infighting. Certainly positioning, I think that's the best way of putting it, between the politicians across Europe as to how we deal with the new trade deals. But in the interim, potentially there's lower growth, isn't there, across Europe?
So the way I look at the Brexit issue, obviously yesterday we didn't see a very big market reaction because it's more of a symbolic day that was very well flagged as opposed to a major shock event. But now that the 2-year process has kicked off, it's going to be a protracted period of negotiations. A lot of the negotiations in the interim, as the continent goes through many elections like in France and in Germany, is probably going to be the UK government facing off of the European Commission. In terms of how it impacts asset prices, that's a bit less straightforward. On the one hand, the weaker sterling has helped UK large caps like the FTSE 100. On the other hand, a lot of the benefits of that weaker sterling are sort of behind us, and we are yet to see the negatives of having a weaker currency, such as the impact of higher inflation on consumption and purchasing power for the UK consumer. So there is an element of some negative effect that is yet to come through the data in the UK that could indicate potentially lower growth, and it will be interesting to see how the market reacts to that, but we need to watch the data. later this year.
What sort of data are you watching for? Because you mentioned inflation. Clearly there's an upward pressure here in the UK because importing higher priced goods and so forth. And I've already mentioned, I think we have in past interviews talked about the potential for some fragility in terms of growth. What do you see? How do you see markets developing? We're almost on the cusp of the second quarter. How do you see things developing over the next 3 or 4 months or so?
So in terms of the data to the first part of your question, I think things like retail sales, consumer confidence surveys, any early indicators are important for us. We publish on our website something called the macro GPS, which is a pretty cool indicator because it mixes traditional economic indicators like the ones I mentioned, plus some social media feed for an early or as early as possible indicator of where future growth could go. That is something we monitor very closely to see where growth expectations could go. In terms of the translation of that to where we see markets in the next 3 months, I think there is some potential for hiccups in markets like US equities, where you may not continue to see the S&P 500 breaking through record highs like it has gotten us used to. But that does not mean lack of investment opportunities, because there are other return opportunities outside of the US, such as in Eurozone equities, in Japanese equities, in EM equities. And in fixed income, there are some interesting dynamics in EM again, so emerging market debt. From a strategic standpoint, we see this as a positive asset class, as well as any inflation-linked exposures, which position you well for continued inflation.
Okay, all right. We'll look forward to seeing how the second quarter develops. But Karim, in the meantime, thanks indeed for joining us. With a look back at the reaction to the failure of Donald Trump's bill on healthcare last week through to Brexit and into the second quarter. That's Karim Chedid from Blackrock.